Hi everyone and welcome back. As you may know, stock markets in India are close to record highs and have been on a bull run since April last year. Stock market participation has also increased with more than a crore new accounts being opened on various discount brokers like Zerodha, Upstocks and so on. In fact, as of last month, in its annual report for 2021, the RBI actually stated that the Indian markets were in a bubble and then went on to discuss whether this bubble was rational. While there's no consensus on this, there is some evidence to suggest that Indian markets may be at least overvalued as we get close to the peak of this bull run. So today we're going to look at the current state of Indian markets, contrast that with macroeconomic indicators, and finally talk about something that may protect you from all this volatility, which is diversification. Since their lows following the lockdowns of last year, both major indices in India have pretty much doubled. A kind of general metric to look at the value of these indices and markets is a PE or price to earnings ratio. The formula for this is the current price of the share divided by the earnings per share, but a simple way to look at it is the amount of premium that an investor would pay to buy the stock of a company for every rupee of profit that it makes. Now, this is not a perfect indicator by any means since it looks at profit after tax and doesn't really look at liabilities, debt, leverage, that kind of thing, but it is a good general measure. This also comes with a bit of a caveat as a lot of companies had their earnings reduced by the impacts of the pandemic last year, and these reduced earnings kind of boosted these PE ratios as well. If we have a look at the historical average for Sensex compared with the PE ratio of the index right now, we can see that the current market is at over 1.5 times the historical average. And this is just the major index. If you compare this to BSE small cap or mid cap, you can see that those have performed even better than the main index. So we can see that right now in the current market regime, investors are happy to pay a very high premium on a company's earnings because of the way the markets have performed in the last year. At the same time, if you have a look at macroeconomic indicators, we can see that those have worsened. While we're seeing India's share in global market cap rise, we're also seeing India's share in global GDP fall. We all know that India's GDP contracted last year, and even coming off a lower base this year, the growth estimates have been revised down because of the continued impact of COVID. To combat this, the RBI had taken on several liquidity boosting measures to revitalize and stimulate the economy. However, as is the case with accommodative monetary policy, an unintended side effect of this can be an increase in inflation. And this is what we're seeing in India today, with inflation over the last few months going over the RBI's tolerance threshold of 6%. In the same annual report for 2021, the RBI also states that the liquidity measures that they have taken cannot be unrestrained and indefinite. This means that there might be a scale back of this kind of monetary policy in the future. In the same report, the RBI also goes on to say that the increase in money supply from central banks the world over, combined with FPI of foreign portfolio investment coming into India, is responsible for the asset price inflation that we are seeing. Basically, the stimulus measures taken by central banks the world over in terms of boosting money supply through quantitative easing, reducing the interest rates cannot last forever. In an earlier video about Dogecoin and market bubbles, we had spoken about the life cycle of a bubble and the different stages in it. One of these end stages is profit booking, where savvy investors begin to book their profits and exit the market as their targets are met. And we are seeing some activity like this. Earlier this week, for a couple of days, we saw a dip in the small cap and mid cap indices, and a lot of people are attributing that to profit booking on the part of investors. So how can one protect themselves from such uncertain and possibly volatile conditions in the market and economy right now? The answer to a lot of this is diversification. Diversification, as a lot of you may know, is the process of spreading your investments across different industries, financial products, and even asset classes to mitigate risk. Before we go any further, we should talk about the different kinds of risk that you can protect yourself against. On one hand, you have unsystematic risk, which may be company or industry specific. So when you diversify within your equity portfolio, you are protecting from unsystematic risk. On the other hand, you have systematic risk, which is tied to the broader movement of financial markets. When looking at multi-asset portfolios, a lot of people tend to look at asset correlation. For example, if two assets are negatively correlated, they basically tend to move in opposite directions and therefore can be used as a hedge against each other. So what are some of these different assets and how are they correlated to equity markets? One of them obviously would be real estate. A paper from 2019 had a look at the data from 2012 to 17 in BRICS countries to study the volatility and correlation between REITs and stock markets. The results of this study implied that there were spillover effects between stocks and REITs, and that REITs could be used as a hedge against stock prices. If we look at physical real estate, as in properties, there are also studies showing evidence of negative asset correlation with stocks. A study from Germany looked at the correlation between real estate prices and equity. They found a small but negative correlation between this direct property investment index and the returns of stock markets. Another asset class that is generally regarded to have a negative correlation with equity is gold. When financial products and markets tend to become a bit overheated or overvalued, people tend to look at gold as an alternative store of value. So, in the event that there is a correction in financial markets, having a small percentage of gold in your portfolio can help reduce and arrest the slide. Obviously, since physical gold isn't exactly easy to store and keep, for this you can look at different products such as gold ETFs and sovereign gold bonds. There is also the trending asset class of 2021, which is cryptocurrencies. While crypto was earlier seen to be unconnected to financial markets, this seems to be changing as it becomes a more popular choice for contemporary investors. As of May, there was a small but positive correlation between the price of Bitcoin and the levels of Nasdaq, for example. However, the fact still remains that the underlying system behind cryptocurrencies is decentralized and is going to be separate in some way from the financial market. Ideally, over time, every investor should look to create a basket of products from different asset classes if they are looking to mitigate risk. Alright everyone, I hope that this video shed some light on the current state of financial markets and the economy and how diversification could help reduce risk for you in 2021. Thank you and see you again soon.